Hello, everyone. As an analyst with Talk Tickers, I've seen a lot of investment trends come and go, but one that's really gaining steam is copy trading. Now, the promise is huge, professional level expertise, but totally automated. So the big question is this a real game changer for the modern investor, or is it just a high-risk gamble? Let's dive in and find out.
I mean, that's really the core question, isn't it? Can you actually get the results of a pro without putting in the years and years of work in market analysis? That right there is the powerful appeal of copy trading. In this explainer, we're going to break down how it all works, shine a light on the risks that aren't always so obvious, and take a look at where this whole thing is headed.
So, what is copy trading exactly? Well, at its core, it's pretty simple. It's an automated system where your investment account is set up to mirror the trades of a seasoned investor that you pick. The best analogy I've heard, it's basically like getting to copy the answers from the smartest student in the class. When they make a move, you make the exact same move. Instantly.
And the process itself is surprisingly straightforward. First, you do your research and pick a trader to follow. Then, you decide how much of your money you want to allocate to their strategy. After that, the platform takes over and automates everything, mirroring every single trade. And from then on, your account's performance just follows theirs, for better or for worse.
Now, here's a really crucial point. Copy trading and mirror trading are not the same thing. People use them interchangeably, but they're different. With copy trading, you're following a person, a human trader with their own strategy, their own intuition. It's like building a people-based portfolio. Mirror trading, on the other hand, is when you follow a pre-programmed algorithm, a trading bot. It's the difference between human judgment and a cold-coded system. So what's the big draw? Why is this so popular? Well, for one, you get immediate access to expert strategies without the steep learning curve. You can actually learn a ton just by watching a pro in action. And the whole thing is simplified and automated, which means it's a super low-commitment way to get into the markets. Plus, it's a fantastic tool for diversifying your own strategies. But you knew there was a but coming, right? It's not all sunshine and rainbows. And this quote really gets to the heart of it. In copy trading, fees are the silent partner in every profit. Ignore them, and they'll claim more than their share. It's a powerful way of saying that in the world of investing, nothing is ever truly free. So let's actually break down those costs. First up, you've got performance fees. That's a cut of your profits that goes right to the trader you're copying. Then there are platform fees, the usual suspects like spreads and commissions. And you really have to watch out for the so-called hidden costs, things like slippage or overnight fees, because they can quietly eat away at your bottom line.
Let's just zero in on that first one, because it can be a biggie, performance fees. We're talking about a range of 5 to 30%. I want you to really think about that for a second. That means for every $100 of profit you make, as much as $30 could go straight to the trader before you see a dime. That has a huge compounding effect over time.
Okay, now to keep things fair, any platform worth its salt will use something called the High Watermark Principle. This is absolutely critical, so listen up. It basically means you only pay performance fees on new profits. That is, gains that push your account to a brand new peak. You never get charged fees just for making back money you previously lost. Honestly, this should be a non-negotiable feature for you.
But the risks go way beyond just the fees. First, there's always market risk. That trader's amazing track record, it's no guarantee of the future. Then there's just plain old human error. Even the best traders have bad days. And here's a subtle but important one. Execution risk. Things like slippage. You see a price, you click buy, but the order fills a fraction of a second later at a slightly worse price. That tiny difference can really add up over thousands of trades and make your results different from the leaders. And maybe the biggest risks are psychological. You lose direct control over your capital, and it's so easy to become over-reliant on just one person.
All right, so we've talked about the promise and we've talked about the pitfalls. So how do you actually approach this with a smart strategic mindset? Let's build a quick playbook for managing risk. Here are 5 key things to keep in mind. 1. Choose a reputable, regulated platform. That is your number one defense. 2. Do your homework on the trader. Look past the big return number. Check out their risk score, their history. 3. Diversify. Please do not put all your eggs in one basket. 4. You have to monitor your portfolio. This is not a set it and forget it kind of deal. And 5. Use the tools the platform gives you, like stop losses, to define your limits from the very beginning. And let's just double down on that diversification point, because it is that important.
A really solid rule of thumb is to never allocate more than, say, 10 to 20% of your copy trading money to any one single trader. Why? It just builds resilience. If one of your star traders has an absolutely terrible month, it won't completely sink your portfolio. It's a simple rule, but it's powerful. So, where does this all go from here? Let's look into the crystal ball at the future of following. We'll focus on the two big forces shaping this industry: regulation and innovation. First off, it's really important to get that this isn't some lawless Wild West. Copy trading is a regulated financial activity, and the rules change depending on where you live. You've got major players like the FCA in the UK and ESMA in Europe setting the standards. In Europe, it's often treated just like portfolio management, which means very strict rules. In the US, the regulations are even tighter, which is why you just don't see as many platforms available there. And you can see a major body like ESMA, the European Securities and Markets Authority, is deeply involved, providing guidance to make sure investors are protected. This is a good thing. It's a sign that the industry is growing up and being taken seriously. It's all about making this a safer, more transparent space for everyone. Now, looking ahead, the innovation pipeline is really exciting. We're moving past just simple mirroring. Think about AI tools that act like a financial matchmaker, pairing you with a trader whose risk profile is a perfect match for your own. We're also going to see more social features, building real communities. But the potential game changer: decentralization. Imagine copy trading that runs entirely on the blockchain with smart contracts. We're talking about radical transparency, where every trade is public, and a system where the code is law. That could completely flip the script. Which brings us right back to where we started. Is copy trading the future of investing, or is it just a shortcut to taking on a ton of risk? Well, from what we're seeing, it looks like it's here to stay. But it's so important to see it for what it is. It's not a shortcut to guaranteed riches. It's a shortcut to accessing complex strategies. Your success is still going to depend on your own research, your own strategy, and a very clear-eyed understanding of the risks. And of course, before we wrap up, I have to remind you that everything we've discussed today is for informational purposes only. This is not financial advice.